Hey, Dave with Applied Accounting Dynamics. I wanted to take a couple minutes and talk with you about 4 very common causes of tax surprises. Nobody likes tax surprises. That's not like Christmas. It's not that kind of surprise, right? They're all avoidable, and I want to tell you what to do to avoid them. These are based on the most common things that I've seen in years of practice. The first one is what I call phantom income, and it doesn't mean that you're getting income from a ghost. What it means is you may not be getting cash, but you could have income. Most commonly, I see this with people own part of S corporation or partnership or rental properties or something like that, and that entity is making money, maybe shows a profit, but they're not paying you something. So the thought is, I'm not getting paid anything, I don't have any income. Not true. All those entities file returns, and they tell the government, look, here's how much of this profit belongs to this person, this person, this person. So if you're not having a disbursement from them to pay for the taxes, or you're not otherwise planning to pay for the taxes, during the year or year end, you can have a surprise, and you can avoid that with proper planning. The next one that's very common I see is retirement withdrawals. I'm not talking about during retirement, I'm talking about before retirement. Right now, a lot of people have had to probably dip into their retirement accounts a little bit to take some money out just to pay expenses, people not working and things like that. Sometimes you have to do that. What you do need to understand is, unless you qualify for some of the very strict exceptions, and most of the time people don't, first-time home buyer or there's a few others, but you're going to be assessed regular income tax plus a 10% early withdrawal penalty, because that's in a tax qualified account. So if you have like a 401k or an IRA and you pull that money out and your marginal tax rate is about 20%, say, you're going to have a 30% tax burden federally on that. Okay, and so even if you have money withheld by the entity for you at that time, that may not be enough. And so you need to plan for that. Better to take out a bigger amount and then have that paid immediately in an estimated tax payment or something, then you don't have to do it later. Easier to pay in the beginning. Third one, income changes. This is usually something good, so it's like a good news thing, but it's like a good news, bad news thing. Hey, I just got a promotion or a 30-40% raise. That's great. You probably need to revisit your withholding and make sure it's going to be adequate, because you're not going to be taxed at the same rate that you are now either. For the most part. Maybe the spouse is working part-time, is now working full-time, or hey, I was an employee, now I'm an independent contractor. Well, guess what? Even if your income's the same or a little higher, you're not only going to have regular income tax with your after-expense profits, but most of that profit is going to be subject to self-employment tax. As an employee, your employer pays half of Social Security, Medicare, you pay half. When you're self-employed, you get the privilege of paying both halves. Nobody's doing that for you on your behalf, and nobody's paying the ordinary income tax during the year. So if you don't make plans and set that aside and pay it during the year, you're going to file your taxes and find out, oh, I owe a whole bunch of money, which is avoidable. Deadlines is another one. Okay, there's a very natural human instinct, especially if I think I'm going to owe taxes, right? I don't want to file. Well, even if you can't pay and you think you're going to owe taxes, it's better to file, pay what you can, make payment arrangements or whatever, because, yeah, there's going to be interest and penalty whether you file or not, but late filing penalties are really steep. And it gets even worse if it's a business entity like a corporation or a partnership or whatever. So like in the example of an S corporation or partnership, they will assess a per partner or per shareholder per month fee for every month or part of a month that it's late. So that can be, like in a month or two, over $1,000 or several $1,000s, depending on, how many partners and stuff you have. So those are all avoidable. And a lot of times that happens when people's records aren't right. You know what? Talk with your tax professional ahead of time or as that's going, and figure out, hey, if these books can't be fixed by an extended deadline, you know what? File something that's as close as you can get and then amend it if you have to, but you don't want to pay late filing penalties. It is very, very, very costly. So those are the 4 big ones that you can avoid. Phantom income, pay attention to it. It's real. Retirement withdrawals, plan for the taxes when they happen. If your income changes, amount or type, get with somebody during the year. Don't wait till filing time. And don't ignore deadlines of anything you're supposed to file. If so, as those things are happening, talk to your tax professional. If you don't have someone to talk to, a 5 or 10 minute conversation that we're not going to charge you for, we can probably tell you what you need to do during the year to avoid a surprise. I hope this helps. Have a great rest of your week. Take care.